All right, guys, so let's continue with our mentorship. Today is day 27. Told you guys that we might be pushing into November because we still have about 4 days, including today, 27, 28, 29, and 30. We have about 4 days left. All right, and today is 30th of October. So I think we'll be pushing into November, maybe around 2nd of November, right? I think we'll be ending on 2nd of November. That's what we'll be ending our mentorship. All right, so that is it. Now let's talk about um, what happened on the market yesterday. So we started our daily bias session yesterday, talking about daily bias, how to frame trades ideas based on what the market is doing. So we're going to do the market mentorship today, right? Just to give you more perspective to what we're talking about yesterday. Then tomorrow we'll not talk about high probability order blocks, right? So I said I was going to do it today, but I want you guys to understand something first. So we're going to do market mentorship first. Market mentorship this is part two. We had our first market mentorship some days back. We're gonna have another one. So market mentorship is just like going through what happened the previous day and then giving you a breakdown of what you should have done and what you could do in the future. All right. So now we talk about the whole idea of top-down analysis yesterday. All right. So now look at this chart very carefully. Let's take a look at this. This is market mentorship now. Now look at this. What you guys daily buy yesterday, and now let us take a look at GBPUSD. Because I actually was anticipating this move. All right. So look at Euro USD, so GBPUSD. You notice that we are coming from a fair value gap. I told you guys that fair value gaps act as what? A magnet and a wall, right? That's what I told you guys yesterday. Don't forget. So now we hit that wall, right? We hit that wall I was talking about. We see we hit this first gap, we hit the second gap. I can see how price was reacting there. Now, look at what happened yesterday. Let's cut out this. Let's cut out this. Let's cut out this. Let's take away this market action, right? So yesterday we were looking at yesterday's price action. This is what I was looking at, and I actually had this in mind. Now, looking at yesterday's price action, right? Let's play a bit. That's sped up. How do I do this now? Okay. Let's go back. So yesterday I was looking at this market action, right? Remember I told you guys that fair value gap acts as a wall, right? And whenever you hit a fair value gap, expect price to kind of react to the upside. Now, on Monday we had the high and low of this candle. So we had this high and we had this low. Right? That was the low and high we had to work with yesterday. And in my opinion, if we are bouncing from this fair value gap wall, right? I was anticipating that the price was going to push higher to the high because to me, my draw on liquidity was the high of Monday, right? It was the high of Monday because we were adjusting from what? A bullish fair value gap, right? That's what I was looking at. I was anticipating some kind of bullish market action because looking at this action, I can't really see a reason why price should go down because I told you guys that the market wants to bounce off something. So there was nothing for the market to bounce off to continue dropping because now we had the wall down here, right? Even if the market was to bounce down, I was looking at, okay, is it possible that we can come to this fair value gap up here? Or we have a gap here. So in my mind, I was like, okay, if they're coming from a wall, we are bouncing off a wall, right? Isn't it logical to expect that this wall, right, this wall was going to, go something like a bounce here, and then maybe to this fair value gap here? Because to me, this is a bullish draw on liquidity, and then we have this high here. So to me, I was expecting that the market should likely go higher because now we are inside a very, very discount market. We had a kind of shift of market structure here. Market should retrace at least to form a lower high. We have been having consecutive down days, and these down days have been reducing with velocity. But you can see how the down days are very smooth. You can see this BB candles, but from where you can see market has been slowing down. That means the volume is beginning to reduce, right? And then the market will likely want to do a retrace to form a lower high if it should continue being bearish, right? So I was hoping the market should maybe come up here and then push down. Now, if you go to the lower time frame, I think I should take this off now. So I've marked the high and low, the kind of look. So if you go to the lower time frame of that day, consider there was something very unique, right? So look at the market action of yesterday. So this is the high of that day. This is the high of Monday, right? This is the high of Monday we're looking at, right? This is a high, and this is the low, right? This is the low we're looking at, right? So on this market action, you could see that there was some kind of bullish markets. The market was kind of creating bullish higher highs and higher lows. And now, watch this. After the Asian range was printed, we had what a kind of bullish continuation break, right? Markets went above this swing high, right? That was a bullish continuation. And then we had what we came back into this last down push, which is what I call an order flow, right? And now, if you compare this market with Euro USD, you notice that Euro USD was dropping while GBPUSD was refusing to drop. And I told you guys something about SMT divergence, that when the correlating pair is not moving in the same direction with the pair in which it's correlated with, that may be a sign of what? A divergence. Right? I told you that about that as a correlation yesterday. So watch this. We go see that at this point here, GBPUSD was finding it difficult to go down, while Euro USD was dropping significantly. So we can see that there was an SMT divergence here. You can see that was actually what market was failing to make a low. Meanwhile, there was a very free fall here. Look at this from here. I think you can see this free fall here. I see a free fall, right? So EUSD, which correlates with GPUSD, was giving a free fall, while GPUSD was not giving that free fall. That was what made him to say, okay, this market should go bullish, right? It should go bullish because of all this SM leverage. And then we have this previous very high, which is waiting at this top here, right? So that was what I was looking at. So my bias was for this day was bullish because of this high. Because the market has been giving impulsive bullish legs. Like I see from this, you can see this impulsive bullish leg. You can see that bullish break again, and then coupled with the SMT divergence, right? So that was what led me to believe that this market was going to go bullish, right? It was going to go bullish. You can see the market bought and hit that level nicely, right? Although I wasn't able to catch an entry because the markets did not give me one. Right, I was able to get an entry because ordinarily, if I was looking for an entry here, I would love to see markets, go above this high. Something like this. Let me show you. Something like this. And then come to retest. And then push higher, right? That's what I would love to see. But the market didn't do that. The market just went with a high immediately, right? So that was it. Right, so that was what happened. There was no real clear entry here. And that's maybe you call this last move, but no, that when market take liquidity, we don't want to take a buy again. Maybe if you took a buy after market, came back down here, that would have been no probability for me because I wanted to be part of this move that take out this high, this liquidity high. All right, so that did not happen. So the market kind of bumped the high a bit, retraced. Maybe if you like playing this kind of trades where you use very large stop loss, so I said there was an entry here, kind of breaker block. So this is breaker here. So this breaker. Maybe you are using this breaker block, maybe you have caught this, maybe both sides this breaker block and then was pushed higher. Right, but me, I didn't really like how the market was looking. I wanted a very clear defined move. Right, so going to the 3 minutes time frame, this is a breaker here. Right, so this, if you take this trade, the stop loss would have been much. That's why I didn't take it. I was like, I wanted the price to drop a bit more. Right, if you're taking your breaker, stop loss will be somewhere around this low here. Right, so around there, somewhere below this lows here, this candle low. So the risk reward was very poor. It's a 1 is to 1.2. 1 to 1.1, right? 1.12. So I don't really feel this, right? So that's why I did not take it. But this is just to give you perspective. Now, the goal of this is at least see, there are two things you do in the markets, right? When you come to your chart, there are two things you do. The first thing you do is to what? Is to read the market. You don't necessarily need to trade. You just want to learn how to read the market because um there are two things you get from reading the market. It's not every day you must take a trade, right? It's not every move you must take a trade. Reading the market is also an advantage because it gives you what experience. You're able to know what it gives you that experience. Okay, this is what um call it reading the tape. So this is what you do sometimes. Sometimes it's not every market that you must take a trade. You can have a bias and say, okay, I expect the market to go to this level, and then you watch it and see if there'll be an entry. So reading the tape is actually different from what actually executing, right? So these are the two things you do. So you can either be reading the tape or you're actually executing trades, right? So reading the tape builds your experience. You can see how I anticipated this bullishness, although I did not get a trade because um, reading the tape is different from getting a trade because if you're reading the tape, you're just trying to give a perspective to what the market is doing. Why executing is you're not using your analysis to actually get involved. So it's not necessary or it's not compulsory rather for you to be in a trade that you are interpreting. Sometimes you just come to build experience because sometimes the entry would not be what you want to see. Like me, this entry wasn't what I wanted personally. I was hoping, I was personally hoping that price was going to drop maybe to this last area here. I just thought me, I was hoping that price will could retrace at least down to this down level here, and then I get involved so I can get a better risk reward. So that's what I was hoping the market will do, like it will drop lower. Right? You can see that did not happen. This will give me a very good risk reward because if I took my entry here in the buy limit inside this area here, and I've gotten a very nice risk reward from here to that high, I'll be like 1 is to 3.6. That's what I wanted. When market to push lower there and I give my entry. It did not happen. So I didn't take the trade. But I was actually reading the tape. I was watching this on my laptop. I was watching this move on my laptop, but I didn't take it because of what I did not see what I would have loved to see. Right. So reading the tape is very important because it helps you to frame ideas. You're able to get used to know what the market is going to do. It kind of gives you experience without actually taking trades. So whenever you come to the chart, always show up. Like some people always say, you always have to shop every day, but you don't have to trade every day. You can shop without trading, right? You can come to the market and analyze and have a perspective without actually trading because reading the tape is part of building experience. It's not only by taking trades because when you're taking trades you shouldn't take, you're going to be taking more losses than you shouldn't have taken, right? So you're going to expose yourself to risk. So sometimes just come to the market and read the tape. Just okay, read the markets. Okay, the market should go to this level based on this, and that. You just as a watch what the market does, and then you're out of the market. It's not necessary that you must, be part of what the market is doing every single day or every single move rather. So let us also read the tape on gold. I took a trade on gold. Right? I took a trade on gold. I took a trade on gold. It was a very nice one. We made an all-time high on gold yesterday. All right. So let's just see if I can see. I want to use. Okay, let's follow us come. All right. So we had gold. Look at also watching gold. This one I actually took this trade. I actually took this one. So I took this one. I took this one on gold. Right. This is also reading the tape. Right. I actually took this one on gold. I actually bought this. Now look at gold very carefully. Ignore today, and you can check my Twitter. You see I actually took this trade on MT5. Right. When I posted my chart, Right. So I was looking at gold. Gold has been giving very bullish sentiment. We have to tap into this gap here. Had this favorable gap inside there. Because price, I told you that it's a wall. Remember, I told you guys it's a wall. And favorable gaps are like walls and magnets. When price hits it, it reacts. Right. So you can see our price came to our wall there. Right. Market came into that wall, and like I said, it was pushing higher. So for me, I was looking at this high because this is the most recent high I can find. I was setting price to make a new high because we bounced off a wall. Remember, I told you guys that gaps act like walls and magnets. Once it draws price to itself, it now begins to act as what a pushback. Okay, it's pushing back price. All right, so that's basically what happened here. Right, so I was expecting a buy here. So now if you go to the lower time frame, you'll see I actually called this buy. So what was I looking at? This is we're reading the tape now. All right. So I was looking at this. Okay, so we had that high resting up there. Right. So we had that daily high resting there. And then I was looking at this particular market. Right. So we saw a bullish push to the upside. All right. So we saw a kind of bullish move. So I think I took it on the 5 minutes chart. That's why I took it from the 5 minutes. So I can say that okay, from this is Asian range. So I kind of divided the Asian range into two because so this was the Asian range. I kind of broke it into two. So the upper half was the premium, the lower half was the discount. So I was looking at the discount of this range, right? So this was the lower half of the range, right? So and then we had this bullish bias. And not only that, we had liquidity resting here. Look at this. I was looking at this liquidity here. Look at this equal highs here, right? So now, after New York session begun, right, I saw price, fail to go lower because normally this market should have dropped lower, right? Although this is where you get very, very delicate. There was liquidity resting here, right? But I was bullish on this market, right? So I actually ignored that because we had was a liquidity sweep here, right? So about price failed to go lower, right? So I kind of ignored the one lower because we already took the one that was higher, right? So the market gave a bullish break during the New York session, right? This push happened, and then the market gave a bullish break. So look at the bullish break here. So bullish break here. So the market gave a bullish break, and then we had what this equal liquidity here. We had this daily high here. So I simply took a trade on this market. I took a buy inside this market here. Right, this is just the daily bias, right? I ignored the lower one, so I used the upper liquidity grab as my fuel, and then we had what a fair value gap inside here. So you can see this big gap here. I can see this big fair value gap here. So there are two ways of entering this trade. Either you do a trade inside the fair value gap, or you use towards this other block, like this other block here. This was being yours. Either do this or that. So this will also be your entry. This other block here. Either you use a gap or the other block. You know why you use it, having a good entry for this. But for me personally, I didn't use any of that. I just simply use what this low. So as the market swept this low, I was in. Like this low was my inducement. I just thought that I took my buy just below that low. Like inducement, I just took it. And I knew that low was inside the same balance. And this imbalance was also was above or this other block. So I just took my buy there. I put myself loss just a bit below the low. So I took my buy around this level, just below that low. Right, below that inducement low there. Right. Then my stop loss was just up around there. So just somewhere around there. And I was targeting this high here, this equal higher. I didn't target this equal higher, which already marked out here. So you can see how the market was very, very nice one. So just about 1 to 2 for me, whatever about yeah. 1 to 2. So I got it 1 to 2 for me. So I just took it. So I didn't want to hold for this high here, right? Because you can see what happened. You can see that immediately price took out this high. Can you see that retracement, right? Can you see the market took out this high? Can you see this big down push? So I don't really like those kind of moves. I like sometimes this down push can end up coming back with your entry. So I always like to take my profit at easiest places, like easy highs. I don't want to extend it because sometimes price can do this and now come and reverse on you or come out to your entry. So some people might have chosen here, that is fine. But me, I like to choose an area where I feel the market might react because the same way fair value gaps act as wall, right? Whenever price take a liquidity, it tends to react, right? So I took my take profit there and I quit the trade for the day. So you can see that you would have had to endure this drawdown. You can see the market to be traced from here down all points here. That was more than 50 points or 50 pips, right? So that is basically it. So that is it. So I actually took that and I took my profit here. So if you had it, that would be nice for you. And that is good, right? So this is market mentorship. This is how I was able to get this trade at this. I just want to give you guys real examples of these things I'm teaching you guys about. So tomorrow we'll continue with our tutorial sessions. This was just a market mentorship series, just to give you a perspective of what the market did on GBPUSD and so gold has made an all-time high. So congrats to gold. There has been an all-time high on gold, right? So we hit 2782 level, right? So we hit 2782 level yesterday. So let's see, can we price make a new high? I don't know. So let's watch what happened on gold today. Right, this is the daily chart of gold, and yeah, it has been very bullish. Like you can see, it's this kind of very massive. All right, so let's watch what happened today. So we'll see. I'll see you guys in tomorrow's class. Have a wonderful day.